I'm going to introduce our speaker, Stephen Hanson. Stephen has, I've known Stephen for probably 10 years, worked with him and his partner, Marshall Pollack from Transworld Business Advisors on selling businesses, buying businesses, getting company books in order. And 2 years ago, Stephen took on the CEO position of a dental supply company, orthodontic supply company, and brought me in to help as the CFO of the company, so-called CFO. So I don't even, Stephen, I'm going to just turn it over to you because you know everything about buying and selling businesses. So I'll let you take it from here, and then any additional information you want to talk about yourself, go for it.
Remain, thanks so much. I appreciate being here with everybody today. And what a group of prestigious people. Your backgrounds. You probably could give this presentation without me. So, but we'll go from we'll start and go from there. Maybe just a little bit about me, just so you kind of know where I'm coming from in my career. I'm not a spring chicken. I've been around for a while, but I started my career. Actually, I was a geologist. So I was a scientist. Then was kind of looking, like, but do I want to get a PhD in this field? Kind of thought that would be what I should do. Decided I really wasn't a great PhD candidate, so I went and got an MBA. I thought I'd be a bridge between the scientists and management, and work place like Shell or one of these big kind of companies like that. And I got sidetracked during my MBA program when I was doing a marketing research project. Got involved with a company that made heart pacemakers, and I did a research project for them. They ended up hiring me, and I decided, well, that's kind of an interesting field. So I was in the implantable medical device field for 35 years, from heart pacemakers to implantable hips, heart valves. It was a Fortune 100 company, and I became a divisional president for the dental implant division, which was out here in Carlsbad, California. The company was called Sulzer Medica, as a Swiss firm, which now became part of Zimmer Biomet, and which is a large medical device company. I left corporate America after a long run. I actually started my own medical device company and had a lot of fun with that. And then I sold it, and I thought, I really wish I knew what I knew now about selling a business, because I definitely left money on the table. But I'm not mad about that. Just the way it was. And decided I needed to do something in my life because my wife didn't want me at home all the time. We had a good marriage, didn't want to ruin it by staying home all the time. So I had to get back to work, and decided to use some of the tools I had learned in my career, and became a business broker. And we opened our firm up almost 15 years ago as part of Transworld. And so yeah, I think there's one other Transworld persons too here, and it's been a great run. So with that, as far as I'm concerned, in this meeting, open dialogue, is fine with me, and try to answer your questions or get a conversation going, and learn from each other. So I'll go from there. I think I'm supposed to share my screen, so bear with me while I do that. Get the right one. And I hope you can all see that.
Yep.
Yeah.
Yes, we can.
Yes.
I got to get rid of that. Why is that there? Okay. All right. So, this is now, I've got something here telling me I've got to get rid of that. It's going to mimic my voice. Why is that there? I'm going to stop the screen share for a second, see if I can get rid of that.
Steve, I think that's the AI. That's the Zoom AI that's capturing the discussion.
Yeah. Oh, maybe it's just capturing the discussion, huh? Thanks.
Yeah. It'll make those notes available for us later.
Okay. Well, then I got to really be careful what I say.
Yeah, that's right.
Okay. So you can see that?
Yes, we can.
Okay. Okay. So just a little bit, Transworld, in case you don't know who it is, we're the largest business brokerage firm in the United States. We have about 260 offices nationwide in about 16 countries. Um, for the most part, we deal, the whole, most of the time, business brokers are really working with sellers, the sell side, and then we try to find buyers. So when Ruvain and I were talking a little bit, and he said, "What really would like to talk a little bit more about what buyers are looking for in a business." I said, "Hey, that's an interesting concept and discussion point because we tend as business brokers to focus a lot on what are getting a seller and what the seller wants to get done, et cetera, and then the buyer is quite frankly almost secondary, and that really is changing over the last few years where we really need to focus on what buyers want in a business and is the business ready to be sold because the buyers are much more educated today than they were in the past. When I first started, in the last 15 years, with the internet now, with AI, buyers know a lot more, or they come to the table with a lot more knowledge than they may have in the past about the process. And if we're not ready for them, they're basically going to walk away from a deal. So this is just a little bit about Transworld and why you should work with us. So we'll get through that and just move on. So our discussion really today is about buyers and what they're looking for, and we can pivot and move to different topics as necessary and you'd like to along the way. But in general, what does a buyer want from a business, right? And what kind of buyer is it? There are different kinds of buyers out there, and does that make a difference at all? Maybe to the seller, and when you're getting the business ready, there are people who are looking to buy a job, and then there are those that are looking for a strategic or buyer or a foreign buyer. But are there common elements to all of those buyers that a seller needs to be thinking about, and also some exit planning by the seller, and is the target business ready to sell? Okay, I know a number of you mentioned you do some exit planning, and this is an area where it's still it's difficult often, especially with a smaller business owner, to get them to invest even time but some money to get their business ready to sell. And maybe we could talk about some of the major pitfalls we're trying to get sellers prepared for when they go to market, um, that they may not be aware of. Okay. So with that, so in general, the first kind of buyer, and the most typical business, maybe I should stop for just a second. Sorry. Most of my work that I do is from Main Street to business with an enterprise value of $20 million. Okay, so about $20 million down to Main Street. After that, typically goes to a more of an M&A process, which Transworld does, but that's the concentration of my work. Okay. So the typical buyer, is looking to buy a job. They're leaving corporate America, they got laid off, they're bored, they want to work on their own. So they're going to be buying a job, and they're going to run the business that they buy. Okay, so they need to have the skills, and they may have other family members that are going to work for them, but in general, they're going to be the person who is going to run the business. Okay. Other two types of main buyers out there are, as I mentioned before, strategic buyers. So one thing that's happening right now across the United States, in the HVAC business area, there are a lot of roll-ups going on in HVAC. A lot of the trades are doing that. HVAC is a bit ahead of the game on that, where a lot of strategic buyers are coming in and buying up, large to medium and even now smaller HVAC businesses and bringing them all together and bundling them up. So we have a lot of strategic buyers doing that. Machine shops is another one that is regularly going through that phase. And then we have foreign buyers, people coming in to invest in America to obtain a green card or a simple E2 visa. Maybe some of you have worked with buyers who are trying to get an E2 visa. They have to make a quote substantial investment in the United States, and they need to have employees. So even a simple E2 visa, which is like California, you need to invest $150,000 or so to buy a business because it needs to have employees and to qualify. Can't be just like a one-person band. Okay, so that's a main buyer pool. But regardless of those buyers, are there some common elements? So I thought we'd try to talk about those today. What are the common elements that buyers are looking for when they're looking for a business? So, I answer my own question. Yeah, there are. There are a number of things that we can see that pretty much commonly come up when a buyer is looking at a business, whether they're strategic, a foreign buyer, or again, a person looking to buy a business that they're going to run themselves. So let's try to go through some of those. And I highlighted some. I'm sure I haven't put them all down. And again, any comments, questions, you want to have an open dialogue, we'll try to do that. Okay. Feel free to chime in. So most of you are in the financial area, right? CPAs and stuff. The number one thing is good books and records. Okay. I mean, this is, it may seem to all of you to be so fundamental, but it isn't to a lot of people and to a lot of owners. They've been just doing what they've been doing, but they don't necessarily have, good books and records. So buyers expect to have good books and records, and with those, that means professionally done tax returns and financial statements that amazingly need to agree with each other. And that may get some good laughs from folks, right? But when you get a tax return and you're showing that to a buyer, and then they're looking at the P&L and balance sheet, and they're different. I mean, substantially different. Now, some things got to be the same, right? Revenues, maybe let's say your net profit, sure, maybe, but there are other areas where a CPA is going to take the balance, the income statement, for example, and move some things around. They may take some wages and put it up into cost of goods or move a few things around like that. So you may get your cost of goods number may be a little bit different, therefore your gross profit, than your P&L, but the revenue and the bottom line usually are pretty much in sync. They may be off a little bit after the CPA cleans it up, but because often we get a tax return, we get a P&L that has been before the CPA's cleaned it up, in case the person maybe made some mistakes along the way. But sometimes they vastly disagree, and then that's a big red flag to a buyer that something doesn't seem right with a business. Okay. Also, sometimes there are buyers that have multiple companies, and they group all the businesses together into one tax return. And maybe a number of you have seen that before. And while that is maybe convenient for them and costs them less when they're for their tax preparer, when it comes to getting an SBA loan, the SBA bank wants to see a separate tax return for the target company. So if there's 3 or 4 companies that are different types of companies all rolled up into one return, we need to usually break that out. That can be a real problem. We have to often restate some tax returns because the tax returns, the SBA banks typically want a separate standalone tax return. You can get around it, but it's, in general, if you had So if you were working with a business owner and he or she had three different companies, and they rolled everything up into one tax return, and you knew that they were working towards an exit, you'd want to start talking to them about breaking out their tax returns and filing a separate tax return, but at least for the target company. Okay. Most businesses in the range that I work in are based off of SDE. So I know all of you know about EBITDA, and SDE is very similar to EBITDA. However, we're taking out the cost of the owner. So EBITDA basically is cost of sales less operating expenses. I can go through this. The main one is right down here. We can add back the salary for our one owner and the payroll taxes. That's the biggest difference between that and EBITDA. And these are the typical add backs that the SBA banks will recognize. So we can add those things back right away. Depreciation, amortization, interest, salary for one owner. If there are two owners, you can only add back one. So usually, maybe if one gets paid more than another, add back the most expensive one in their payroll taxes.
Stephen, couple of comments. I think it was a project I did with Marshall about 4 or 5 years ago, where we were looking at a business, and the books were so screwed up that we just walked away. And about 3 weeks after we walked away, the sellers came to me, and they said, we like the way you analyzed it. Can you help us sell the business? So I went back, restated the books, and they sold it within 3 weeks. And the broker who was representing them said, I've been trying to sell this business for 3 years. The way you presented things and made it easy to understand, sold it within 3 weeks. So that's kind of, what you're talking about.
Absolutely. We sent a business to you yesterday, Ruvain, that has the same problem. Their books and records are totally messed up. It's a good business, but
Yep.
the way the books and records have been done, buyers, as soon as they look at them, walk away. They need to be cleaned up and put into a format that a buyer can look at and feel comfortable that what they're reading is true and factual, and that they are comfortable moving forward with a major investment, right? They're going to be throwing down, whether it's $200,000 or $2 million or more, they're putting basically their life savings down, and they're going to take out a big loan. And if it's an SBA loan, most likely they're going to be putting their house up for collateral. So it's a huge investment for them, right? So if
the other thing regarding these add backs is there's always the owner disclosing, oh, by the way, I had this personal expense here and this personal expense here, and we should really take it out. So included in these add backs is always going to be the owner wanting to add back as much as possible for personal expenses versus, business. And there's always a give and take. You want to comment on that, Stephen?
Sure. And I do have a slide a little bit later on that, but let's jump ahead because it really doesn't matter when we put it in. So add backs. I think maybe you're all familiar with that. Those are going to be expenses that we can add back to profits, right? For an adjusted net. And that is what we're going to apply the multiple to for that industry segment to come up with a value. Okay, it just in general, just simple as that. So a business, an SBA bank, and a buyer, when they see add backs, okay, if the owner said, I have a business, it doesn't really need my personal car in it, but I have my, my Chevy, Equinox that I put through the books, and you can add, it's pretty simple to add that back, and you can explain that to a buyer pretty easily, right? There could be how, my daughter is in college, but I pay her a small salary, basically it's an allowance to her. And that is usually things like that are pretty explainable, and people and the bank could understand it, and people can get kind of comfortable with it. But when you get a host of ad backs, for example, you have a line item on the P&L that says, supplies. And then the owner says, well, virtually 95% of it is personal. And so every Amazon expense that was in there was personal. Everything from Target, whatever, pick a business. They added it all back, all these personal things back into the bit. They want to add them back to, as ad backs. When banks and buyers see so many ad backs like that, they get nervous, because it's, how are they going to really know that that was a vacation to Hawaii, right? Can you prove it? You're going to have to go through a lot of work to do that. So, often when we're doing that recast and on ad backs, there are some ad backs that where the owner may say, well, that $500 expense or that $1,000 expense or whatever was an ad back. And we may say, you know what, we're just going to leave it there. We're not going to add it back, because it's probably not going to change the valuation that much. And if we add back too many things, we get too nitpicky. I'm going to add back $30 for that, because that package I sent was a Christmas present to a nephew, and it wasn't really a business expense. It's going to start looking too busy and too nitpicky, and buyers aren't going to buy it. They're just going to start smelling like, well, what else is not really part of the business, right? Maybe all of you have seen that. So, and the SBA bank in general, these are the only ones, the ones I've listed up here, that they're pretty much going to guarantee that they'll accept. All the other ones, you're going to have to really kind of prove to the bank. And there are some, like that car, for example, they could see that. Or let's say they had an employee lawsuit a year ago, a time and wage lawsuit, and they had a $5,000 legal bill. That's a non-recurring bill. You could probably very easily prove that to the bank, prove it to a buyer, and you could add that back pretty comfortably. But if you just kind of willy-nilly say, hey, I'm going to be adding back X amount of my professional fees back because I've been padding it for years, no one's going to really buy it. Books are going to start looking messy. I guess that's my comment to you. Their books are going to look messy. So clean them up, get them to stop adding up all their kids' expenses, kids' cell phones, all of their vacations back, and clean up their books going forward. Get it ready for sale. Does that make sense? Hope it does. Okay. Ruvain,
Yes.
does that help? Okay.
Oh, absolutely.
Okay.
Now, before you move on, someone had a question. Mark asked, you mentioned exit planning as part of the process. Do you or someone within your organization provide these services, or do you typically refer them out?
So we do some basic exit planning services for business owners. Some of them are just really complimentary. We just say, hey, try to get these things done. But in general, we refer them out. That's really not our gig. It's a full-time job, and for a professional with those expertise. So we look for people to bring in to help assist with the exit planning, because there are so many different factors of it. And I guess that could be another lecture, another day presentation, Ruvain. But so in general, we refer most of that out. Okay, books and records and evaluation. So often, a buyer, is going to want to know whether a broker opinion of value was done, and they're going to want to see that. Basically, evaluation of the business. And when we're going to get down to that SDE number, typically a weighted number, using the last year's, the most heavily weighted, and going back and reducing the years. Let's see, if you have 3 to 5 years. So when I first started out in this industry, we typically use 3 years to do an analysis, and we would weight them. And the most recent year was the highest weighted, right? Since the pandemic, we're really trying to go back in general, most of the time, 5 years. Really want to see that 2019 number. And most buyers, whether I want to see it or not too, but most buyers want to see what was this business doing in 2019 and how did the pandemic affect it? And most businesses had went one way or the other. They had a dip during the pandemic, and then hopefully they've come back. Okay, they've come back or they haven't come back. Okay, and some have had a bump. They had a nice bump for 21 and 22, and then uh, things started going back down in 23, closer to 2019. So how do you value that? On both cases, if you had the dip and you've come back up, great, you're kind of back to where you were. But if you're at 2019, you went way up and you've come back down to where you were, what does the seller want to value it on? They want to value it on the bump, right? I was way up here, right? And the buyer's going, yeah, but you're back down to where you were before COVID. You got a benefit of COVID. Now you're kind of back to where you were now that we have 2023 financial results, basically for most companies. So that's one of those real push and shoves you're going to get with a seller. And a buyer is going to be looking at, they want to see that whether there was a trough or a bump along the way. So I assume that makes sense to everybody, right? And then that multiple, okay, is the seller shooting for the moon? And we have resources as a business broker we can go to that gives basically an average, from from high to low and the median of per industry for the multiple. The median multiple nationwide for a business is 2.2. Okay. But there are some businesses, let's say a manufacturing business, distribution business, they're typically 3 and over. And the buyers could find those multiples on the internet. So if a seller has too high a multiple, often the buyers are just going to walk away. They're not going to even want to be interested because they're just going to assume that the seller is being unreasonable and will be just too difficult to deal with, whether it's in due diligence or in the negotiation of getting to a price that they'll agree to. So got to coach the seller a lot on that, but buyers are a lot more attuned to what a reasonable valuation should be. So with that in mind, just, it's not in my notes here at all, but it just something that I deal with a fair amount, and maybe you guys do in your practices, that the ones of you that do valuations. So we'll run across a number of valuations. Someone will say, oh, I had a valuation done, and it was their CPA. Nothing against you guys as CPAs, right? But it was like, well, what were you instructing your CPA to do in the valuation? Right? Because it may have been, they want to get a tax bump up, right? They want to get they want the highest possible price to reset, for tax purposes, and so the CPA used a pretty high multiple. And then when it comes to, then I get it and I look at it and I tell them, well, this is really nice stuff, really good work, but the multiple that the CPA used or whoever the valuator used is way too high. And then you get into a real struggle then with that seller of, well, what do you mean it's too high? I just paid, $3,000, $5,000 or whatever they paid, even more at times, for a valuation, and they told me it was worth a lot more money. So But again, if buyers are pretty savvy on what a multiple should be, and again, if the seller is looking for too high a multiple, they may not just even engage with that business and pass on it. So, buyers want businesses that are profitable. Okay. There are a lot of times business owners will come to me and say, I've got a business that's really great, it's doing really good, and makes no money. And can you sell it? And in today's market, I mean, can you sell it? I guess you can sell almost anything, but you're not going to get very much money for it. They think, well, I put $500,000 in it, I want to get all my money back, but the business isn't making any money. So they're not going to get back that return, and buyers aren't going to pay for it. And so businesses that aren't profitable basically won't sell. So if you're working with a business owner and they want to sell and they're not profitable, then in your exit planning, you need to have a good deep dive with that business owner and find out what they can do to get it to be profitable and to start generating some money. Maybe they got to make some cuts in certain areas or whatever, because the two biggest things typically that they're going to be paying for are wages and rent. So rent can often be difficult if they're locked into a longer term rent to get out of, to lower that expense. So maybe it's wages, maybe there are other things you're going to have to look at to help make that business profitable. Hopefully you can. Okay. And sellers will often say to me, yeah, but there's a lot of opportunity. I've been a semi-absentee owner, right? And I have Charlie or Jane running it, and I kind of show up once in a while. But boy, that another person who came in to run it all the time, there's a ton of opportunity out there, and they could really make it into something much bigger. And I can see a number of you nodding your head, right? And so they should pay for that. Just in general, rule of thumb, buyers are not going to pay for opportunity, right? They're not going to buy that. That is something they hope to have, but it's going to be their blood, sweat, tears, their money, and all the things they do to take advantage of that opportunity. They're going to need working capital to take it, most likely, right? To take it to build on that opportunity out there. So they're not going to pay the seller for all that opportunity. And quite frankly, if the business doesn't have any opportunity, they're probably not going to buy it anyway. It's going to be a really difficult business to sell if it doesn't have any opportunity. But often you'll hear that from sellers. There's a lot of opportunity. Buyers are savvy, and they're not going to pay for opportunity. They expect to have it. So what else? What can help? What are other things that buyers look for that can help the sale of a business? Reoccurring revenue is a big one. If there's a customer base with repeat sales, contracts with long-term services, or if it's a subscription model, those will usually have a higher multiple, and people like those kind of businesses versus ones that have, it's a one-off. Let's say for my business, for example, in general, if I sell a business, I'm kind of done with that client. I've got to continually get new businesses. Your business, most of you who are CPAs, you're going to have a book of business of clients. So when you go to sell your practice, whatever, you're hopefully going to be able to sell that book to another CPA. So that would be very helpful. But if you have businesses like that have repeat business, so much the better. Growth potential. So this kind of goes along with that opportunity one too, right? But buyers do want businesses with have some growth potential and an ability to expand. If they look at it and it seems like it's tapped out and it can't grow anymore, long as they feel like they can keep it at that level, and again, the seller's being reasonable with the price, it can be sold. But again, maybe there are things that this new owner can do to through some new marketing efforts bringing in some other products. Let's say it's a ladies dress shop and it's doing well, but a new owner could bring in maybe a line of menswear or children's wear or accessories, jewelry, whatever, some other things into that same shop to expand the business. Uh, those are all things that a buyer is going to be looking for to grow the business because they want something they can grow, right? And in general. Scalability. Now, this is really especially for strategic businesses, right? Businesses that can adapt to a changing market, and that's good for a long-term investment. So they're looking really for a lot of operational efficiency, and often it's going to be one where, let's say I recently sold a machine shop to an investment firm that had 5 other machine shops, and they were rolling it all back. And what were they going to do with that target business? They were going to lift out a whole chunk of the administrative side, purchasing, bookkeeping, a lot of HR issues, a lot of those admin things, and some things on the production side, purchasing for raw materials, things like that. They're going to bring those, they're going to tear that part out of the target business, and they typically combine it into one group. The services all, the other 4 or 5 businesses that they have. So they're going to be going, in their due diligence, they're going to be looking for those costs that they can strip out and bring to the quote, like the admin part of their business. And a regular buyer is going to still need those things, right? In general, they're going to need the payroll department. They're going to need the admin. They're going to need HR, all those things, versus a strategic buyer. That makes sense?
Stephen, a classic example of that is years ago when AT&T bought GTE Wireless. All they were interested in was the cell tower sites. They didn't care about anything else because they could never spend the money or get the permits or whatever to have more cell sites. But to buy the cell sites, that's why they bought GTE.
Absolutely. So yeah, so they're looking for a piece, right? Not the whole business. They may be looking for, so for example, when I was in corporate America, I was in the dental implant business. We were a pretty strong business, but we needed to grow, and there were certain things that we were weak in. We found a target competitor that had strengths that was almost a perfect fit. They had some product line extensions that we really needed, and they had some manufacturing capabilities that we really needed. The rest of the business, in general, we didn't want. So when we went in, we bought them and basically stripped out, 40% of the costs of the business and combined them, and when I sat in front of the board, they said, Steven, so it's 1 + 1 does not equal 2, it equals 3.5. And we don't expect any loss. You got to get rid of the costs, and you got to grow this business in the first year. It was really kind of fun, but we did accomplish that. And so that was like you were talking about with that example, Ruvain, with a strategic buyer. Yeah, they're usually looking. They're going to make some changes along the way. And of course, what is a seller? The seller has their baby that they've had for 40 years or 2 generations, and they talk a lot about, well, I want to take care of my employees, and I want to make sure my legacy business continues to run and operate. And there's where I have to come in often as the broker and actually kind of tell the buyer, you don't really need to divulge all the things you're going to change. Keep your little piece of paper over there in your due diligence. You don't need to tell the seller all the things you're going to change on day one, because it's going to upset them, because they want their legacy to move forward. Once you own it, you can do what you want to do. But in general, it's better to, as a buyer, I have to coach the buyer on that to kind of leave some of your plans in place. Now, on the flip side of it, when you try to sell yourself as a buyer, and you're coming in to buy a job, and there are a number of people working there, and let's say the owner's daughter or son works in the business, other family members, and other people he or she's been working with for 20 years, you may want to say a little bit more, but coach them that, hey, I need all those employees, because they do, right? A buyer coming in under those circumstances that's buying a job, if everybody left, they'd be dead in general, right? So often a comment a buyer who's buying a job is, will the people stay? And they want some reassurances, and I think I have a slide on that later, but they want reassurances that employees are going to stay in that business, because they need good people. And everybody is out there right now probably knows, at least in the San Diego area, unemployment's very low, and it's really hard to find good qualified people. So if you're buying a business, you're hoping you can retain your employees, or at least most of them, right? There may be some you want to get rid of for whatever reason, but you want to retain them. So,
Okay, Stephen, a couple of questions.
yeah.
What, if any, information and when should the seller convey to their employees about an impending exit strategy?
Yeah, that comes up a lot, and some sellers, it's kind of interesting. Some sellers, they want to tell their employees day one that the business is for sale, or when the offer comes through, they want to tell them right away. And you never know what's going to happen in due diligence, even after an offer has been in place, or the process to sell a business. So let's maybe talk about that for a second. In general, okay, from the day a business, at least for a business broker, from the day we sign the marketing agreement and they're going to go to market to close a deal, the national average, and that's not just a Transworld number, but the national average for a business broker is about 10 months. Well, that's a long process. So if you've been telling your employees for 10 months, that the business is going to be sold, there's a good chance you're going to lose a lot of your employees, or you're going to lose some key employees. So the general rule of thumb is you keep your mouth shut and don't tell them anything, and try to keep as small a group as possible during getting ready for the sale. And maybe you have to use outside people for that then, so that you don't disrupt that inner circle of people that you don't want to lose, because a buyer wants to keep those people. Um, and um, and then during the due diligence process too, it's often I have found, especially on a larger deal, that it's much better for the seller to bring in people like yourselves to help them through the process than just their internal people. They usually need some extra help. Um, and I know that there are some of you and some of the groups that you work with. I've heard of before, and I've actually brought some of them in to work with me on some deals. But in general, I brought Ravane in to work on groups. I brought attorneys in, all types of people from outside the business on the sale.
Okay, in line with this, someone asked, can you value golden handcuff agreements to retain existing employees?
Anything like that is very difficult. So in general, maybe in a larger deal, something more in the M&A space, that might be more something that you could value more. But in a smaller deal, probably they're not going to exist anyway, and a buyer probably won't be paying for it. So that will be a tough one.
Okay, and then Bill asked, what if there are pending tax law changes that will affect the cash flow? How does a buyer take that into account? And is the seller required to disclose it?
So general rule of thumb on disclosure. is that a seller, so we have, for example, a form we send to a seller and to a buyer, and they need to disclose, uh, uh, there's a whole list of questions for them to disclose. So if a seller knew that there was going to be some significant thing coming up, let's say they were importing product from another country, let's say it was China, for example, and they knew that there was going to be next year, a bill was passed the next year that the duties were going to go up 10%, whatever. A seller should be disclosing that. Absolutely. And if they don't, they're going to basically probably walk into a lawsuit uh, as soon as after the acquisition and the buyer finds out because it wasn't disclosed. So the general rule of thumb is disclose, disclose, disclose. You know,
Okay,
yeah.
Stephen, I know you need to leave at 9:45, so there are a couple of more questions. You want to continue with the presentation, or how would you like to proceed?
Yeah, let me just, I think that these are, I'd rather have the questions, I think.
Okay,
And just, yeah, because these questions, I think these are pretty, how much time do we have? We got about 10 more minutes before I
10
have
more
to leave.
minutes that you wanted. We can
Let
go
me just
longer.
make sure that these are pretty straightforward, but things that maybe make this comment before we take a few more questions that, legal and regulatory compliance. Okay, you've got your tax returns done, right? You're in good standing with EDD in California. You're basically your payroll taxes. If you're an ISO regulated company, then your ISO, all those things are up to date. Now, here's where you got to get into, I didn't mention it earlier, but asset purchases versus stock purchases, right? Where you're going to be stock purchase, where you're going to buy the shares of the business. Asset purchase, you're going to basically form a new co if you don't already have one, and you're going to buy the assets of the business and put it into the new business. But if the business has, for example, ISO approvals, and they're not transferable, so often then we're going to do a stock sale so that there's a little more risk to the buyer on that. So you got to do a lot more due diligence. But in those are some areas where you really need to be to look at what are the goals of the buyer and what do they need. HR compliance, handbooks, W-2 versus 1099s. I deal with that still. It's like, all my workers are 1099 and they all should be W-2 people. So you're going to have to go like, okay, you want to dance out there and be and potentially get, the California come in and slam you on that. But as a business broker, I got to recast everything as though they were W-2 employees. And I got to add in payroll taxes and items like that, because that's what the buyer going forward is going to be looking at the business, right? So those are some kind of things that can sneak up on you. Again, buyers are educated, and overall they know what, in general, they know what they're looking for and at, and the seller better be ready. So, you know, uh, here's just a little note back to a seller. Buyers are educated, are you? So are you doing your exit planning? Are you the face of the business? So for example, I had a small um, auto shop, Paolo's Auto Shop. Paolo ran the business. Everybody knew Paolo. So if you could really kind of think about it, if you really wanted to sell maybe a year, maybe two more, he could change that to, San Diego County Auto Shop. Start changing the name so it's not just him, and get another mechanic in there. Make sure that he's not just the face of the business, so that a buyer doesn't think, oh, Paolo's not there, no one's going to show up. So if you're the face of the business, what can you do to kind of help diminish that? Again, your books and records need to be in good shape. Cash, they go like, hey, you can say, but I have an extra $500,000 in cash comes in. You can't sell cash. So you may say, hey, you know what? You're going to start paying taxes on it. Put it through your books, pay your taxes on it, but record it as income and get your cash, start accounting for your cash. We talked about add backs, right? So just, get those in order, and don't put everything under the sun into the through the business. And then make sure your tax returns and financial statements are prepared professionally. And as I mentioned earlier, that they're harmonious. They agree with each other. We really try to tell people, stop doing your books by yourself, or if you are, at least then make sure a CPA or professional bookkeeper reviews them, gets them straightened out, and make sure a CPA is doing your return. You're not doing them yourself or through, an online tax return group. So I think the rest is kind of a little bit of whatever. Maybe I'll stop there and let's take some questions. And I hope this information was of value. The slides will be available to you. Joyce and Ravane will make sure you get those. And I hope this was
Okay, Stephen,
good information, and I'd be glad to take some more questions.
okay, first question in the chat, what resources are available to help the owners understand their industry, multiple range that can be considered directly correct before engaging with a professional valuation?
So what I would recommend, okay, so for example, I would say to you that if you know a business owner, most business brokers would be glad to talk to a business owner about their business and give them, a complimentary discussion and help them along the way. And it's part of kind of what we do. So one would be to, get them in touch with a business broker. Business broker can give them some insight into what they need to do to get their business prepared for sale. Business brokers will also do, not all business brokers, but for example, our office, we do valuations. If you as a CPA came to us, but we thought you were going to be doing the valuation, we're not going to try to cut you out and steal it from you. But so we need to just make sure we know about that ahead of time. But otherwise, most business brokers will either do a small complimentary valuation, but a more in-depth one they'll typically charge for.
Any other questions? Okay, so Stephen, thank you so much. The slides will be available, the tape will be available. And we're going to move on. I want to talk about the next meeting and future meetings. So Stephen, thank you so much for your time.
Thank you, everybody, for your time today. It was a pleasure being with you. I hope you found it valuable, and I look forward to meeting many of you along the way. And all the best. Have a great day.